Welcome to video 1.3 of our Business Tax Fundamentals series. Today we're exploring partnerships, a business structure that combines the tax simplicity of the sole proprietorship with the ability to have multiple owners. Partnerships introduce some complexities, but they're incredibly flexible and can be perfect for the right business situation. Whether you're considering bringing on a business partner or you're a tax professional who needs to understand partnership taxation, this video will give you everything you need to know about the partnership. Some important educational disclaimers. ProfessorVillard.com is an independent educational support service and is not affiliated with any educational institution. Students enroll in academic courses should communicate directly with their professor through the university or college's official learning management or institutional email. The content shared here is for educational purposes only. And while RTH Worldwide LLC may offer professional services through youraccountantsusa.com or tuscontadoresusa.com, the use of educational materials from ProfessorVillard.com does not establish any professional engagement, contractual relationship between you and or our business or me as your professor. Here's what we'll cover today. We'll start with the partnership formation, the different types of partnerships available. I'll explain the crucial differences between general and limited partnerships because it affects both the liability and the management rights of each partner. Then we'll dive into pass-through taxation, how partnerships avoid entity-level tax, but still must file a tax return. We'll look at the Form 1065, as well as the Schedule K-1 that partners will receive at the end of the year. I'll explain a little bit about partner basis, a concept that confuses many people, but is essential for understanding distributions and losses. We'll discuss partnership agreements, why they're absolutely critical, and finally, we'll talk about when the partnership makes sense and when you should consider an alternative form of business. A partnership is simply a business owned by two or more people who share the profits and losses. Here's some important things the partnership can do. Basically, if two or more people are in business together, that is automatically treated as a partnership. So a husband and wife who were a sole proprietor all of a sudden start doing business together. That sole proprietorship has now technically become a partnership. No formal filing is required for a general partnership, and basically this automatic formation can technically catch people off guard. I've seen friends start small businesses together, thinking they're just working together, only to discover that they've inadvertently created a partnership with all the tax and legal implications that come with it. A partnership is simply a business owned by two or more people who share in the profits and losses. If two people start a business together with the intent to share the profits, they've created a partnership whether they realize it or not. Some of the key characteristics of the partnership is that, like the sole proprietorship that we discussed in our previous lecture, the partnership also suffers from unlimited personal liability, one of the biggest negatives to this business entity. In addition to that, self-employment tax, very similar to what the sole proprietorship also experienced. When we talk about partnerships, we're going to talk about two different types of partnerships, and this is crucial to understand. In a general partnership, all partners have management rights and unlimited liability. Any partner can make a decision that binds the entire partnership, and all partners are personally liable for partnership debts. Limited partners, on the other hand, have two classes of partners: the general partner, who manages the business, as well as and have unlimited personal liability, as well as the limited partners, which are simply investors. They cannot participate in the day-to-day management of the business, but they are generally entitled to limited liability protection. Limited partners must file with the state, while a general partnership does not have to file with the state. So basically, this is the trade-off for the limited partners in order to get a little bit of liability protection. Some pass-through taxation fundamentals. Essentially, partnerships pay no federal income taxes themselves. Instead, the income or losses pass through the partnership to the individual partners. The partners will then pay tax on their share of the partnership income and losses. Essentially, partners are taxed when they receive distributions, are taxed whether they receive distributions or not. So even if the partnership was profitable but you didn't receive any income from it, you are still held liable for the income tax liability. So the pass-through tax foundation of the partnership is crucial to understand. Here's an example. The partnership itself paid no income tax on its net income. Instead, all of the income or loss passed through the partnership, who each one reports his or her share. And here's the surprise to some people. Partners are taxed on their allocated share of partnership income, whether received in cash or not. This is crucial to understand. If the partnership makes $150,000 but only distributes $100,000, the partners still pay tax on the full $150,000 amount. This could potentially create a cash flow problem if not managed properly. Here's what the 1065 partnership taxation form is going to look like, at least the first part of the form. So even though partnerships don't pay income taxes, they must still file a 1065. This is an informational return that reports the partnership's income, deductions, and how everything is allocated amongst different partners. The typical due date is March 15th for a partnership whose fiscal year ends or tax year ends on December 31st. This is earlier than the individual income tax return. Schedule K1 is going to summarize all of the partnership's share of income that goes to each one of the individual partners, deductions, credits, etc. Each partner receives a K1 that shows their individual share. The partnership must also provide a balance sheet and various reconciling schedules. Even though no tax is due at the partnership level, accuracy is critical because they potentially have an effect on the individual partner's personal income tax return. Here's a little sample of what the K1 looks like, and everything will get distributed. Primarily the things itemized here are itemized because they could potentially have a different tax treatment at the time that this gets included into the individual partner's individual income tax return. So each partner receives their K1, breaking down their share. Things like Section 179 deduction, charitable contributions, and many other items. This will be used to complete the personal income tax return. Ordinary income goes on the 1040, capital gains goes on the 1040 Schedule D, etc. For general partners, any share of partnership income is also going to be subject to self-employment tax. The K1 can be very complex, which is why many partners will ultimately need professional help with their personal tax returns. Partnership basis is one of the most important and confusing concepts in partnership taxation. Your basis starts with what you contribute, and that's cash, plus the adjusted basis of any property that you contribute. Your basis will increase when the partnership makes money or takes on debt, and decrease when you distribute or the partnership loses money. Why this matters? Well, first, you can only deduct partnership losses up to the amount of your partnership basis. Second, distributions in excess of basis are taxable as capital gains. Third, when you sell your partnership interest, your gain or loss depends on your basis. Many partners don't track their bases properly, and will get surprised when it comes time to file your taxes. Partnership agreements are absolutely essential. Even though they're not legally required for a general partnership, basically without a written agreement, state default rules will apply. And those default rules may not match what the partnership's intent is. Most states default to equal sharing of profits and losses, regardless of contributions, and equal management rights for all partners. I've seen partnerships destroyed because partners have different expectations about profit sharing, decision-making authority, or what happens when someone wants out. A good partnership agreement addresses profit allocation, management structure, capital requirements, distribution policies, and procedures for admitting new partners or handling the withdrawal of a partner. Don't try to save money by skipping on this. Invest in professional legal help, or at very, very, very least, draft a sample partnership agreement. Your actions in the next step after this video. First, if you're considering your partnership, honestly evaluate the compatibility and make sure you can agree on the fundamental business terms before you go any further. Second, consider your liability exposure. Partnerships might not provide enough protection. Third, track your basis and have good record keeping from the very beginning. Don't try to recreate this information later. Finally, invest in professional help for your partnership agreement or your tax return at the end of the year. Partnership taxation is not generally a DIY type of a project. In our next videos, we'll explore the limited liability companies, the business structure that combines the best of the partnership and the corporation while avoiding many of the drawbacks. We'll see you in the next lecture. I'm Professor Robert Villar, and I hope I'll see you soon.